federal COVID relief programs, an update. And it seems like with many of these things, the rules change fairly often. So we're going to give you the latest information that we have on these. And again, talk about how they interact with each other to a large degree. Here's our standard disclaimer, which again, since many of us have been to these many times, if you pull up these slides 2 weeks from now, the rules may have changed. So we're giving you what we know as of right now, but obviously we can't speak for what changes to the rules may come in the future. So our agenda today, we're going to talk about PPP loans, both the first round and the second round loans. We're going to talk about the employee retention credit. We're going to talk about provider relief funds, the shuttered venue operator grants. Then we're going to talk about the double dip, which is really how some of these programs can interact with each other in a way that actually creates risk, and how there are some specific strategies to reduce that risk. And then this idea about getting help, we'll talk about at the end in terms of some of the ways that that might be beneficial. This slide, don't let this intimidate you. It's a lot of information and it's fairly small print. So depending on what kind of screen you have, you may not be able to read this. But I put this up here because this is our one-page reference guide to some of the more common COVID aid programs that are out there right now, or that people are talking about right now. And this, obviously summarizing this onto one page, we leave a lot of details out, so you can't learn everything you need to know about these programs from this one-page summary. But I think one of the things we observe is that it can be very confusing because each of these programs has its own rules and regulations, its own terms and conditions. And if you have this kind of a reference guide, it can keep you focused on which one you're talking about at any given moment, because they interact with each other, often in conversation, you shift from one to the next pretty quickly in a conversation, and it gets easy to get confused about which one you're talking about in any particular sentence. So having a quick reference guide, and I included it here in the slides so that everyone can have it, to just give you the high-level reminder of what each of these programs is and how they compare and contrast with each other in terms of the general terms and conditions. And again, there's a lot of details that don't fit on this one piece of paper, but this can serve to sort of ground the conversation to remind people, hey, right now we're talking about this. So let's not get distracted by the rules and regulations of the other programs. So I share that with you, and we found it useful as we're talking through some of these things. Specific to individual organizations. So let's get into the Paycheck Protection Program loans, and we're actually going to launch our first polling question. So a reminder for those who are CPAs and want the CPE credit, you have to answer the polls, and that should have been launched. So hopefully you can see it right there. And the question is, my organization's involvement with the Paycheck Protection Program is best described as: we have an original PPP loan and forgiveness is complete. We have a PPP loan and we haven't done forgiveness yet. We already have a second loan. Or what is the Paycheck Protection Program? Now, I want to acknowledge, I know a lot of people are answering already, which I appreciate. It's very possible that multiple of these are true for you. You could easily have a PPP-1 loan. You have not applied for forgiveness yet. And you could also have your second PPP loan. So I understand that more than one option could be true for you, but pick whichever one you feel like going with. And we'll see where we end up in terms of this totally unscientific survey of where people stand on the PPP program. Going to leave the poll open for about 10 more seconds. Again, if you want the CPE credit at the end, you're going to have to reply to these polls. And there's no right or wrong answer. You're not getting a test score here. It's really just to make sure that you're attentive for the CPE credits. So I'm being told that I have 15 more seconds for the poll. So far we have by far the most popular answer is we have an original PPP loan, but we have not applied for forgiveness yet. And that is consistent with what we see kind of across the industry, and especially in nonprofits. We have actually been advising organizations to wait because as the rules change and evolve, the tendency, the trend, if you will, has been that the forgiveness process has gotten both easier when it comes specifically to the PPP, but also more complicated in terms of how you have to understand your PPP forgiveness application in the context of other programs that you may want to take advantage of, and we get into the double dip opportunity or the double dip risk and how to avoid it. So if you've waited, you're in the majority, and we're at the point now where we understand enough about some of these programs where we probably can move forward, and we're actually starting to move forward with some organizations on starting to get those applications in for forgiveness. So let's get into some of the details about PPP loans, and these are the things that come up most as we're talking about the forgiveness process with organizations. The first one is eligibility, and I do hear people express frustration when I bring up eligibility on PPP because they say, look, I got my loan last April. Obviously, I'm eligible. Why do we need to talk about eligibility still? And the reason is that if you have questionable eligibility for whatever reason, and you submit for forgiveness, you're compounding the number of documents you're submitting to the federal government for a program for which you may not be eligible. So you want to be sure that you're eligible before you submit for forgiveness. You're signing off again that you're eligible when you submit that forgiveness application. Back in April, when these loans were first coming out, the rules were changing every day and sometimes more than once a day. So you might have been eligible under what we understood on the day that you applied back in April of 2020, but because there's been so many changes and clarifications to the rules, that answer may have changed a little bit, or you may want to, it's likely that it's worthwhile to reconsider. So if any of these four things are true, we strongly recommend that you think about your eligibility and document that you thought about it and that you can have concluded that you're eligible. First one is, if you have more than 500 employees, it does not mean you're not eligible, but it does mean that someone might question your eligibility. You want to document how you became eligible. The same goes if you have affiliated organizations in a group of corporate entities and the total employment of the group is over 500. Again, doesn't mean you're not eligible. It just means that someone could pose the question, and it's worth your while to put together a written, documented response to how did we get eligible for this. The third one, if you're affiliated with a governmental organization, again, the PPP program is available to governmental organizations in the healthcare and educational fields and some others. But again, you want to document, here's why we're eligible, and have that documented. Don't just assume that you're eligible. And then the last one, nonprofits, you have to be exempt under 501c3, 501c6, or 501c19, certain tribal organizations. If you're not one of those code sections, you're not eligible for PPP. So if you're a 501c4, for example, and you've got a PPP loan, there's a hurdle to get over in terms of explaining that. So understand these things and document your way through them before you apply for forgiveness. We're having refreshed conversations about eligibility with a number of organizations who felt that they were comfortable with their eligibility back in April when they applied, but when we revisit under the evolved rules, they're finding that it's worthwhile to have a fresh conversation and some fresh documentation around it. Forgiveness itself, there's really two components to this. So remember, there's two things. Did you spend the money on the eligible expenditures? But also, did you maintain your FTE levels, or do you qualify for this safe harbor? The safe harbor means you don't have to worry about the FTE part of the calculation. In the safe harbor, there's really two. I know I'm summarizing here, but were you shut down due to a government order related to COVID restrictions? Or did you reduce your FTEs for a period of time and then restore them to the pre-COVID level before the end of 2020? If either of those paths is true for you, then you can qualify for the safe harbor, and you don't have to do all the math on your FTEs related to the forgiveness calculation. And there are some complicating factors here. 3 of them are at the bottom of the slide, but there's others too. So this thing about, did you cut someone by 25%? Did you try to hire people back, but you couldn't find the right people? And did people leave? Did your FTEs go down for totally unrelated reasons that had nothing to do with COVID? All of those things can factor into this FTE calculation and can create complexity, quite frankly, that can affect your forgiveness. So thinking through those things, if they happen to be true for you. And those are the three of the more common ones. Certainly there are other sort of quirky things that can come up as we go through this process. Eligible expenditures, in terms of did you spend the money on eligible expenditures? There originally in the CARES Act were 4 categories. Payroll, which includes health, dental, and vision benefits. And it's not on the slide, but it actually included contributions to retirement plans as well, if you have a 401k or a 403b. Utilities, rent, and interest on mortgages. Those things were the original list of eligible expenditures. The law that was signed on December 27th expanded that to add 4 new categories. And these categories apply retroactively to the date of the CARES Act. So your first round PPP loan that you got last April, you can include these 4 categories in your forgiveness calculation. Covered operations expenditures. This is things like if you have a payroll company that's doing your payroll for you, that can be covered. Property damage costs, if you were affected by the unrest that happened during 2020, and it's not covered by insurance, you can put that in your PPP loan. Covered supplier costs. Restaurants in particular are taking advantage of this in the context of if they have a contract for a supplier of food, and they're buying those supplies, that can be included in PPP, and there's other things in there too. And then covered worker protection expenditures, so masks, gloves, the cute little stickers that you put on the floor to tell people where to stand so they're 6 feet away from everyone else. Those kind of things that you spent money on, those can be included in your PPP forgiveness. The other thing that comes up is this loan necessity questionnaire, and that's an imposing kind of name. In other words, maybe your loan wasn't necessary. It's SBA Form 3509 or 3510, depending on whether you're a for-profit or a not-for-profit organization. It's required for loans over $2 million, and also for affiliate groups. If each affiliate got a loan, maybe none of the individual loans were over $2 million, but the total is over $2 million. Theoretically, you're supposed to prepare this form and submit it to the SBA. And it's the intent of this, the stated intent by the SBA, is to assess your certification, which you made on when you applied for the loan, that current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. That's what you certified to when you applied for the PPP loan. This form is designed, or the stated purpose of it is to help the SBA assess whether that is true for your organization. They're not really there's no clarity on exactly what they're going to do with this information. So if your loan is over $2 million and you haven't looked at this form, it's definitely wise to look at it before you submit for forgiveness, because once you submit for forgiveness, the lender can ask for this form at any time, or will ask for this form, and you have 10 days to supply it to them. So we're strongly recommending that you look at this before you apply for forgiveness. You think about what it says and how it portrays your organization's need, and what kind of story it tells, so that you have your story straight and it's sort of reflected in a way that is, true, but also beneficial to your case, that you actually had a need for the loan. As far as accounting under GAAP, for financial statement purposes, there's 4, and actually there's a 5th model of accounting for PPP loans. If you use the 5th one is if you use international accounting standards. Not many people do that. There's really 2 that are by far the most common. One of them is we call the debt model, and if you're into the technical GAAP stuff, it's topic 470 in the accounting codification. And this basically treats the PPP loan as a loan, a debt obligation, until the day you formally get the communication that it's forgiven. So there's no talk about when am I going to book the revenue. You book the revenue exactly on the day when the forgiveness is communicated to you. The other path that's more common in nonprofits is this government grant model, where you basically say this is a refundable advance. It has terms and conditions, and I'm going to earn the revenue, if you will. I'm going to earn the right to not repay these funds over the course of this 8 to 24 week forgiveness period. As I meet those criteria, I'm earning the right to not repay these funds, which means I'm earning the income. So I'm going to book income as I meet the criteria. Regardless of when I actually do the paperwork, to submit for forgiveness. So many nonprofits, because I think nonprofits are more familiar with a grant arrangement with terms and conditions, and it's sort of more consistent with nonprofit accounting. A lot of nonprofits are doing this. Not all, but many nonprofits are taking this path. This especially helps if you have a fiscal year that straddles the forgiveness period of the PPP loan, and you want to book some of the income in one fiscal year and some in another. It's not all or nothing on the one day when you get the forgiveness. So from a GAAP standpoint, you have two options. I mean, there's two main options. As far as the considerations of this, one of the things we're seeing, and if I may put my auditor hat on for just a minute, when we go out to audit an organization, their decision of whether they're going to pick one path or the other is often based on an earnings management consideration. Earnings management is kind of a not favorable term in audit circles. When management can make a choice to decide, well, I'm going to book this way or that way, and that's how I'm going to decide if I had a surplus or a deficit this year, that's really not the kind of thing that auditors really enjoy hearing. We'd rather know that you're accounting for things the way that you're supposed to. And in this case, the way that you're supposed to is you have an option of which way you're going to go. So there's a lot of flexibility to define which period you're going to record this revenue in. There are footnote disclosures associated with this, whichever option you choose, and your auditor certainly can talk to you about that. But your decision about how much income to book in each period is very flexible based on the guidance that's out there right now for how to account for these loans. The other thing on the single audit reporting, PPP funds are not subject to single audit. That's the latest guidance. There's no indication that that's going to change. However, as you've been living through the last 9 or 10 months, there's been a lot of changes to things before. As of right now, single or PPP funds are not subject to single audit. Other changes that came out, most of this came out of the law that was signed on December 27th. The biggest one is the income tax impact was addressed. So the income from the forgiveness is not taxable income, and the expenses that you're submitting to support your forgiveness are deductible. So there's no income tax impact to the borrower. If you happen to be a taxable entity, there's no income tax impact. They also simplified forgiveness for PPP loans that are under $150,000. There's a new form now. There's 3 forgiveness forms now. The third one is for under $150,000, and it's basically a one-page quick. I'm attesting to the fact that I used it correctly, and you're forgiven. There is an opportunity now to increase your first-round loan if you didn't take it all the first time. So we've found that different lenders have different interpretations of these rules, but most lenders, all lenders, acknowledge that if you were approved for a first-round loan and you elected to take less than the amount you were approved for, you can go back now and make up the difference, and it would count as part of your first-round loan, even though you're getting the money all these months later. So if you were approved for a loan and you took a lower amount for whatever reason, you have to actually fill up and use all of your first-round loan that you were approved for before you can apply for a second-round loan. So this has come up with some organizations who made that choice to take a smaller loan for whatever reason. They do have to show that they've used all of the first-round loan that they were approved for, whether they took it all originally or not. And then this last one, originally from the CARES Act, if you got the EIDL grant of up to $10,000, you had to deduct or reduce your forgiveness on the PPP loan by the $10,000. That is no longer the case. So if you got that EIDL grant, it no longer has any bearing on your PPP loan forgiveness. Those are the key changes. Certainly there were others, but those are sort of the most broadly applied. The new law from December 27th also created the second round PPP loans. And the key element here is do not assume that you can get a PPP2 loan just because you got a first round loan. The eligibility criteria are different. There's 2 levels of this. First is the type of organization. And basically, in terms of organization types, organizations who are eligible for PPP1 loans are eligible for PPP2 loans, except for certain organizations that have foreign relationships, and also any entity that's applying for a shuttered venue operator grant, and we'll talk about what that is in a little bit. The other one is these quantifiable factors, and there's three. You have to meet all of these if you want to get a PPP2 loan. The first one, the employee cutoff is 300, not 500 like it was for the first round loans. It's counted the same way. It's a head count, not an FTE count. Number two, you have to have used or will use the first round loan in its entirety, but you do not have to have applied for forgiveness. You just have to have used it. And then three, this is the part of probably the harder one. You have to have had a gross receipts reduction in a calendar quarter of 2020 as compared to that same calendar quarter in 2019 of at least 25%. Gross receipts for this purpose is different than what people generally think of as the term revenue. This is a key distinction in this calculation, and it has tripped up numerous organizations in their considerations of a PPP2 loan. Gross receipts is not just your income that you have on your income statement. It's defined in the same way as the Form 990 box G at the top, and it's on the slide here. This number includes things like, for example, it includes all your revenue that you would typically think of as revenue, but for something that you don't typically think of as revenue, for investment sales, there is gross receipts includes the gross receipts from the sale, the gross proceeds of the sale. So if you have an investment portfolio on your income statement, and you have sales where there's a gain or a loss generated, and your income statement, you're going to record the gain or the loss. For gross receipts purposes, you have to include the total amount received from the sale, the proceeds of the sale of the securities in your investment portfolio. That can change the calculation quite a bit, especially with the market being so sort of weird in 2020. Some organizations had a lot of investment activity in terms of taking profits in the fourth quarter, and that can throw them out of this 25% reduction in some cases. So keep in mind, it's not simply your income statement revenue in this gross receipts calculation. It's the stuff that's included in this box G, which includes the gross receipts from investment sales. We're seeing people get tripped up on this. So we kind of talked through that. The loan terms, maximum loan amount is average monthly payroll. It's actually calculated the same as the PPP1 loan, with the exception that in industries with a code that starts with the digit 72 can get 3.5 times their payroll. But most borrowers looking for a PPP2 loan are simply using the exact same data they used from 2019 for the first PPP loan. That's definitely the easier path because the bank already has all that data from your first application. And we're finding that if you go to the lender and say, I want a PPP2 loan, I meet the eligibility requirements, and I just want to use all the same data I used last time, that's a really quick way to get your loan through the process because they already have all the data that they need. There is a streamlined process for loans under 150,000 if you're in that category. So if you do happen to be under 150,000, you do not have to fill out a lot of the stuff for the application. It is a streamlined process. Make sure you're filling out the right application, especially if you're under 150,000. So as far as forgiveness goes, it's those same 8 categories that we talked about earlier, including the 4 new ones that were added on December 27th. The forgiveness period is 8 to 24 weeks, and it starts on the day you get the money. So if you got the money today, that's day 1, and you have up to 24 weeks to use the money for the eligible expenditures. You do have to spend 60% of it on payroll, and then non-payroll costs can make up 40%. Many borrowers, we'll talk in a minute, strategically have been finding it easier to just cover the entire loan by payroll. The problem with that is you might need that payroll for something else, and you might be able to take advantage of another program if you free up 40% of your payroll for something like the employee retention credit. And look at that, we're just going to talk about the employee retention credit. It's almost like somebody set it up that way. So polling question, let's go to polling questions. I have a polling question here for you. So my organization's involvement with the employee retention credit would be best described as claimed it for 2020, and we're doing it again for 2021 right now. We're looking into it, probably go back and claim for 2020. We looked into it, and we are not eligible. Or, what is the employee retention credit? And again, there's no wrong answer. It's simply a totally unscientific survey of what your involvement might have been with this. We'll give it a little bit more time. Let me see if I can find the chat here. So we have a couple questions on PPP loans. One of them is, if we get a second PPP loan, can we use it for expenses retroactive? And the answer is no. You would have a new forgiveness period that would start on the day you get the PPP2 loan. That would be day one, and then you have 8 to 24 weeks going forward to spend the money. So expenditure that you had in January of 2021, and then you get your PPP loan on February 10th, those expenses from January cannot be included in your PPP loan. And then the next question talks about, would we have to include provider relief fund payments in the gross receipts calculation for a PPP2 loan? The answer to this is a little more complicated. The PPP2 calculation is defined in the same code sections as the rules about presenting revenue on the 990. So you want to follow how you've historically reported grant funds on the 990. The provider relief funds, essentially, from an accounting standpoint, is grant funding that you're going to recognize as you earn it. If that's how you report it on the 990, then you would include it as income in the consistent manner to how you have historically reported grant funds on the 990. So the short answer to your question is yes. The longer answer is, if you have a different way to report grant income for 990 purposes, then you may have a different answer, but you want to be consistent with what you've done on the 990. So let's see, the poll is done, I believe. Yes, it is. So the most common answer is we looked into it and we are not eligible. It's about roughly a third of the folks. And then a number of people asked, what is the employee retention credit? So let's kind of go through at a high level what this is. And eligibility is a little bit more challenging and complicated to get into. So what it is at its core is a refundable credit against payroll tax remittances. So you do not, most people think about tax credits and they think about income taxes. This is not about income taxes, it's about payroll taxes. So anyone who has employees theoretically can participate in this if they meet the other eligibility rules. The big change on December 27th, prior to December 27th, if you had a PPP loan, you could not do the employee retention credit at all. It was totally off the table, which is why most people didn't think about it, because you had a PPP loan and this was not allowed for you. So very few people really were focused on it. It was really only those who could not get a PPP loan for whatever reason. Now we have this opportunity for the employee retention credit, and this could be up to $5,000 per employee in 2020 and up to $7,000 per employee and for each quarter for the first 2 quarters of 2021, assuming you meet the eligibility requirements, which relate to the number of employees and your revenue. So again, for 2020, it's 50% of your qualified wages up to $10,000 of wages, or $5,000 per person for those who make that much, applied to wages between March 12th and December 31st. If you're an eligible employer, and we'll talk about that in just a second. For 2021, it's 70% of qualified wages up to $10,000 per person per quarter. So that could be, theoretically, $14,000 per employee in 2021 if you qualified for both quarters. To qualify, you have to have a decrease in gross receipts in 2020 of at least 50% in a calendar quarter. And in 2021, it's a 20% reduction, so it's a little bit easier to get in 2020. In 2021. One of the things that is important to remember about this is that the rules are different for 2020 versus 2021, and the opportunity is significantly greater in 2021. There's 2 reasons for that. One is we're still in 2021, so if you qualify for the first quarter of 2021, you can start collecting the credit by reducing your remittances of payroll taxes to the IRS immediately. So you don't have to wait, you don't have to apply, you don't have to do anything. If you believe you qualify for this, you can simply stop paying your payroll taxes, keep the cash, and you are getting paid for the credit in that fashion. That's the immediate cash flow benefit. For 2020, if you go back now and apply for not apply for, but you file an amended Form 941 to claim the credit for 2020, you have to apply for a refund from the IRS and wait for them to send it to you. So it's not an immediate cash flow benefit, which is why we're really focused with organizations on understanding the qualifications and eligibility in 2021 first, then going back and thinking about 2020, because the cash flow benefit in 2021 is more immediate. So eligible employers, you have to, there's two ways you can be eligible for this. One, you were shut down or significantly curtailed or suspended because of a government order related to COVID-19, or you had a significant decline in gross receipts. And for 2020, that is 50% decline for the calendar quarter versus the 2019 calendar quarter. For 2021, it's a 20% decline. So if you have in the fourth quarter of 2020 a reduction of 20% or greater in revenue as compared to the fourth quarter of 2019, that actually qualifies you for the ERC for the first quarter of 2021. This can create some interesting conversations where organizations have strategically, you have year-end adjustments that you might make that might affect your revenue. Some of those adjustments really relate to the earlier quarters of 2020, but you just book it at year-end because that's when you book these things as part of your closing process. And that might mean that you don't have a 20% reduction. However, if you really booked those adjustments back to the quarter that they truly belong in, the fourth quarter might not look as good, and you might actually have a 20% reduction in your gross receipts. So there's some interesting processes that people are going through to understand, do I have a 20% reduction in the fourth quarter or not? And some of these year-end adjustments that you just have always historically just booked in December, you're going back and rethinking, well, should I book those back to the months that they really relate to? And often that can result in a different answer. Qualified wages, if you meet the 50% reduction in gross receipts, employers, if you had in 2020, if you had 100 or fewer employees, you can claim it for all of your employees. You qualify as what they call a small employer. If you have over 100 employees in 2020, you can only claim it for employees who were getting paid but were not actually working. So if someone was getting paid because they tested COVID positive and you had to have them quarantine themselves for a week or two, but you kept them on the payroll, those kind of wages would count even if you have over 100 employees in 2020. And if you qualified because of your business suspension because of a COVID government order, then you qualified for wages paid during the period when you were closed, subject to that order. So these rules, if you're getting confused, it's okay. Don't feel bad. These rules get quite complicated. And for 2021, it's layered on with some additional complications as well as some additional opportunities, because the reduction on a quarter-by-quarter basis is only 20%, and you are qualified as a small employer if you're under 500. So that means if you're under 500 employees and you have that 20% reduction in gross receipts, you can claim the credit for all your employees. And that could be up to $7,000 per person per quarter for people who make over $10,000 in a quarter. There's a little table here that matches those up for 2020 versus 2021. It is a challenge sometimes to interpret these rules, so I want to acknowledge that. And in the time we have together today, we're not going to be able to get through every possible scenario, but I can see some questions popping in there, and we'll get to some questions in just a minute. So some of the practical implications, if you're going to go back and claim this for 2020, you are going to have to amend 941s, and there is some debate about whether you have to amend it for all 4 quarters or if you can take the cumulative effect for the year and just amend your fourth quarter 2020 941. And sometimes many employers have a payroll company who's completing these forms for them, and sometimes it depends on what your payroll company believes is the right way to go. So there's some conversations to be had there with your payroll provider. And then who's going to do this and how much access do they have? You have to share, whoever's going to do this analysis has to have access to all this payroll data. And often the accounting people want to be the person doing that, but they may not typically have access to everyone's salaries and wages. So there's been some interesting conversations there about, well, we can't just start emailing out all these files with everyone's payroll so that this analysis can be done. And there's a desire to do it very quickly, but don't forget about the confidential nature of some of this data that you're going through. And then we have the double dip question. And that is the question where you cannot use the same payroll dollar for the employee retention credit that you used for your PPP forgiveness. So those who've already filed for PPP forgiveness and you used 100% payroll to get your 100% forgiveness, all those payroll dollars are now in question in terms of are they tied up in your PPP process and therefore not available for the employee retention credit. If you haven't filed for forgiveness yet, you have the opportunity to only use 60% of your PPP with payroll and fill up the other 40% with non-payroll things, which would free up that 40% of payroll, theoretically, for the ERC should you be eligible. So there's some strategizing around that, and this is one of the reasons we have been advising folks to wait for the forgiveness application, because you still have that flexibility to think about, am I better off putting all my payroll dollars in PPP, or will I ultimately have a better result if I take some of those and use them for ERC and fill up the PPP with the non-payroll dollars? So that's definitely something to think about as you move forward, especially on the PPP forgiveness. Let's talk for a minute about the Provider Relief Fund. I'm going to go through this a little bit more quickly because we're a little short on time, but and that's because there's just so much to talk about here. So the Provider Relief Fund, there has been, if you're in a healthcare organization, you should know by now if you have provider relief funds. There's been 3 rounds or phases as they call them, and the last one you had to apply in November to be part of that. There is more flexibility now in terms of the use of the funds. You are going to have to eventually report on what you did with these funds, and it has to be in compliance with those allowed expenditures or uses of the funds. There's more flexibility based on what has come out over the last month or so. This idea that you can apply lost revenue as one of the uses of these funds is a little bit unique to this program as opposed to the other programs we're talking about today. You have the ability now to look at your budget versus actual in 2020 and say that my lost revenue is defined based on how far under budget I was on revenue. That can be a preference method for many providers. You also could use your actual prior year from 2019 versus 2020, but those rules get a little bit more complicated. So you have to exercise care when you're deciding which of those methods you're going to do. There are targeted distributions. You can now share these if you have a multi-entity structure. It's now allowed to share them between subsidiaries, and that's okay. There is more money, so there's going to be a phase 4. This was articulated in the law from December 27th. We're not exactly sure how all this money is going to be divided up among providers, but there is another pool of funds that will be coming out in 2021. There is a lot of confusion about the allowable expenses and what you can use this money for. Part of the reason is they've changed the rules, I lost count, probably 30 times since last spring. And so every time they change it, they add what the new rules are, but they don't necessarily take out the old guidance. So when you go into where the guidance is, sometimes you see old stuff in there that may not have been taken out, even though it's been superseded later. It can be very challenging to understand this. So careful attention to what the rules are is very important. And because it's so complicated, I'm not going to provide a list of here's the eligible expenses as of right now, because it's just something that is hard to articulate in a clear way. The lost revenue there's questions about, does PPP revenue need to be included in this calculation of lost revenue? And typically, it becomes a strategic decision in terms of when are you going to recognize the PPP revenue? Because as we talked earlier, you have options related to the PPP revenue recognition. Do you want to book it during the period when you have this provider relief funds? And are you going to need to look at lost revenue, or can you use all the provider relief funds on expenditures without having to use the lost revenue component? And so a lot of those questions, like I said, there's interrelationships between these different programs that have to be strategically fleshed out for your organization based on how 2020 went for you. And by the way, you can use these provider relief funds through the end of June 2021. So it's okay if you can't account for the use of all of them in 2020. You can use them in 2021. There is this portal that they've created. They want you to register for the portal. And they had set a deadline of February 15th to report your use of the funds in 2020 by February 15th. However, as we sit here right now, the format and process for redoing that report has not been rolled out yet. And there's no instructions for how to do it. So the general expectation is they're going to move that deadline back, although to my knowledge, they have not formally moved the deadline. It's still February 15th. We expect they're going to move it because it's simply impossible to prepare for this report since they haven't rolled out what the report is actually going to be. You do have to register in this portal, and we recommend you do that right away. And there's some specific information you need about the organization. They say it takes about 20 minutes, and I think that's fairly consistent with what we've heard people say in terms of how long it actually took them to do it. So let's shift gears for a second and talk about the Shuttered Venue Operator Grant. Again, I want to talk about this one relatively quickly too, because it's very targeted for specific types of organizations, whether they be not-for-profit or for-profit, live venue operators, theaters, museums, and live event promoters. The lobbying activity that happened during 2020 for this was called the Save Our Stages for theaters, whether they be live or movie theaters that were more or less closed for most of 2020. We're lobbying for specific assistance. These grants allow you to receive a grant, not a loan, but a grant of 45% of your 2019 gross earned revenue being sales from admissions, tickets, food, etc., not investment income or contributions. And most organizations who are eligible in the museum and theater space are finding that their grant amount for shuttered venue is much higher than the PPP-2 loan would have been based on that calculation. So it's quite lucrative in terms of the dollars that you might get. However, it's quite restrictive in terms of, first of all, who can apply for it. You have to be one of those 4 types of organizations. There's also this prioritization based on how bad 2020 was for you. They measure that by this gross earned revenue decline of at least 70%. You get top priority, and if you had a gross earned revenue decline of less than 70% in 2020, you are not able to be considered for this until the 28th day after applications open up. Actually, the 29th day after applications open up. One of the other things that's causing some angst on this one is that you have no idea when applications are going to open up. The main reason this causes angst is that you are forbidden from applying for both a shuttered venue grant and a PPP-2 loan. And so, since we don't know when shuttered venue grants are going to open up for applications, you just have to wait while everyone else gets a PPP-2 loan with the risk that the PPP-2 money might run out. And we've had a lot of conversations with theater and museum operators in the context of how long can I wait before I have to just forget about the shuttered venue grant, even though it's more money, and just go for the PPP because the PPP money is going to run out. And I don't know when shuttered venue grant is going to be open. So strategically, this is a challenge, and there's certainly risk in waiting. The good news is the PPP money this time is not going as fast as it went back in the spring. So it seems like there's enough money there that's going to last for a while. Allowable uses of shuttered venue operator grants, more or less everything that's allowed for PPP-2 and some other things. Non-employee compensation, so people who get paid on a 1099 miscellaneous reporting method, they count. You can put them in as a forgivable or as a legitimate use of these funds. And there's no minimum required use of payroll. PPP, you have to use 60% for payroll. The shorter venue grant, there's no such requirement. So you have a lot more flexibility. And that plays into the interaction between these things, because you could use all your payroll for the employee retention credit and not worry about having to apply a certain percentage of payroll to the shuttered venue grant. Other benefits, there is a provision for secondary grants, which would be 50% of the first grant, assuming there's money available. And you also have this use period that's extended, it's 22 months from March 2020 to December 2021. Within that period, the ability to justify the expenditure of those funds is much greater because it's just such a long period of time. It's very restrictive, though. There's a lot of detailed rules. A lot of museums are getting disqualified, if you will, because they don't have an auditorium space with fixed seating. There's also limitations on organizations that are volunteer run and some other limitations. So there's definitely fine print in this one. And the biggest thing, which is not in the fine print, but is a bold headline, is that you cannot have a shuttered venue grant and a PPP2 loan. And in fact, if you apply for a PPP2 loan, you're automatically out of the SVG program. So let's talk about interaction. Now that we've talked a little bit about what these programs are, let's talk about how they interact. You know what? Let's do a polling question first. Poll number 3. Open the poll. So on an overall basis, my organization's financial results for calendar 2020 or the current fiscal year will reflect a surplus, a deficit, close to break even, or I don't know yet. And this is interesting. We went through a global pandemic with massive economic consequences, and we're finding that a lot of organizations are going to have a surplus, which is not what you would inherently expect. But with all the aid here, sometimes that's the way it goes. I'm looking at the chat. There's a lot of specific detailed questions about ERC. One of these says, can you partially close and qualify? So this idea that you're closed by government order and therefore you're eligible for some of these programs for the ERC, you do not have to be fully closed like you did nothing for a period of time because of government orders. The example is a restaurant, and a restaurant that was ordered to close in restaurant dining, but was allowed to do takeout and delivery. They count as being closed by government order, even though they had some activity going on. So if you're a not-for-profit and you have a spectrum of programmatic activities going on, and 40% of them were closed or significantly curtailed, while other ones, maybe residential programs, had to keep going on. There was really no slowdown of the activity there. You can still count that as being closed by government order. You just want to have some documentation around your considerations there. So, if you have 10 programs and one of them is really tiny and that's the one that was closed, maybe you don't make it into saying that we were significantly affected by government closures. But if you have 10 programs and one of them is huge compared to the other ones, and that's the one that was most affected, then the case is pretty strong that you were closed or significantly affected by government order. So this idea of this partial closure, partial effect of government orders is one that requires some documentation and some thought. You don't want to just blindly say, well, we had one little thing on the side that had to get shut down, so we're in. You want to think about that carefully in the context of your overall operation. But you do not have to be in a total shutdown scenario. So as far as the poll goes, we have about a third of the people in a surplus, about a third in close to break even, and the rest of them are split between a deficit and I don't know. So let's talk about the double dip. This is the theory that $1 of expenditure can only support $1 of revenue. And the question that first came up was, does claiming an expense to support your PPP forgiveness mean that you cannot claim it against anything else? And there's some potential double dips here in terms of PPP funding and other federal COVID relief programs. Between federal COVID relief programs and your recurring state funding arrangements, and between these COVID relief programs and programs whose rates of reimbursement are determined via cost reporting. So if you have to report your costs on a CFR or some other kind of cost report, and you also got reimbursed for those costs through the PPP forgiveness, is that okay? And that's what the double dip question is about. And I can tell you the answer is far from clear, or far from consistent. So let's talk about the federal relief programs. If we just look at the PPP 1, 2, the Provider Relief Funds, and the Employee Retention Credit, all of these require the use of payroll expense as an allowable expense. If you have to kind of carve up your payroll expense and figure out which bucket you're going to apply it to. You have your recurring typical funding, which often is from New York State, and then you have these other buckets that need payroll expenses. What's the best strategic place to put these payroll dollars if you don't have enough to cover all these things, which is the case for many providers? State funding arrangements, many states, such as New York, have basically said they consider themselves to be the funder of last resort, which means that they expect you to apply all your other sources of funding first and then come to them for money. This can be a real challenge because most providers don't want to jeopardize their ongoing recurring funding streams to get this one-time funding from the PPP or the ERC. This is causing providers, in some cases, not every case, not a lot of cases, but in some cases, simply just turn down the PPP forgiveness and pay it back because they don't want to jeopardize their ongoing funding into the future, either in the form of having it affect their rates in the future or having it affect their reimbursements in the future. And this question about what effect will this have on future funding from New York State funding arrangements is a valid question that providers should be asking. And often the answer is it won't have any impact and you can move forward, but sometimes the answer is a little more complicated. So some of the things that providers are talking about, strategic positioning, allocating payroll costs to the funding streams based on risk, literally sitting down and saying, of all these funding streams, which one do I want to put payroll dollars to first because it's the most risky that it's going to have a long-term negative impact on me if I'm found to be double dipping in this program. So maybe Medicaid funded positions in terms of your Medicaid cost reporting is number one. Maybe it's specific grants with New York State. Maybe it's the Provider Relief Funds. It's going to vary from organization to organization. I cannot tell you, nor can anyone say, as a blanket statement, address the double dip in this specific way. It's going to vary based on what your funding streams are. It's going to vary based on your risk tolerance, quite frankly. And in many cases, it comes down to a risk tolerance kind of decision. Cutoff for PPP1 forgiveness when 100% forgiveness is reached. So you can pick any number of weeks between 8 and 24. If you feel like you want to have more dollars applied to something else, particularly with the interaction between PPP and the Employee Retention Credit, you have this 24-week period. Maybe you're only going to use payroll from weeks 10 through 24 for the PPP, and those weeks 1 through 9, you're going to use for the Employee Retention Credit. You cannot use the same dollars for both, but you don't have to use all the payroll dollars during the 24-week period just for PPP. You just need to have enough to get to 60% so you can assure yourself 100% forgiveness. Extending the use of the Provider Relief Funds into 2021. If you have a choice where you don't have enough expenses to cover all these things in 2020, you can push the Provider Relief Funds into 2021 and apply those later, rather than double dip. And then revisiting the non-payroll costs allowable for PPP1. If you had an analysis done, but then they added 4 new categories of expenses on December 27th, going back and taking a look at maybe you had some of those expenses that you can apply to your first round PPP before you do your forgiveness application to document that you use those things instead of payroll dollars that you can use somewhere else. Again, there's a lot of strategy here, and it really requires a detailed understanding of each program as well as a detailed understanding of your recurring funding streams and how those work. You have to have all of that understanding at the table, and it doesn't have to be the same person who understands all those things in a single brain, but as a group, you need to have all of that knowledge together in order to make the best decision for your organization. Why bother with all this? I've had people ask me, well, I'm just going for 100% forgiveness based on payroll, and I'm going to let the chips fall wherever they fall with my state funding contract. And that's a way to go. I'm not sure I'd call it a strategy exactly, but it's a choice. Taking a more detailed look at this and a more thoughtful look at this is an opportunity to manage risk and maximize the rewards at the same time. If you don't strategize around this, you could end up repaying some of these funds. You also could end up with costs disallowed or a clawback of funds where the state says, you got paid for these costs through PPP, I'm not paying for them, so I want some of my money back. So this is a risk, and I would guess if you're a December 31 year end, you should be having conversations about some of this, or you will be as you get into the audit cycle in the coming weeks. I want to acknowledge, as a last point here, that fatigue is a factor. People are sick of this stuff. And if you are saying to yourself, I'm so sick of this stuff, I just want it to be over, you are in the majority. Almost everyone just wants it to be over. However, this is the most critical time to really focus on the risks and the opportunities associated with all of this stuff we've been talking about for the last hour. If you are finding that you just don't have time or energy to get to this, it is worthwhile to get outside help. And you're going to say this is a shameless plug for Bonadio to help you with this. However, it really will benefit your organization to get help with this rather than go forward without that full understanding. You understand your recurring funding arrangements. Do you need to bring somebody to the table who understands all these COVID-related funding arrangements so that you can complete the understanding and have a strategy that encompasses all the risks and opportunities of all of them? Let's get to the last polling question. We have 2 minutes, and we're going to get the last polling question in so everyone gets their CPE. So my overall feelings on all of this are best described as I think attention to this would benefit my organization, but I don't have time to do it. Certain that I know everything there is to know about this and do not need help in any way. These public webinars are good, but I don't get detailed enough actionable advice to move forward for my specific situation, or I have no feelings about this anymore, I just want it to be over. And it's entirely possible that more than one of these answers could be true. So, as far as number C goes, I definitely acknowledge in these public webinars, in a 60-minute webinar, it's impossible to answer everyone's detailed situation. And that's because there's so many different scenarios that can present themselves for different organizations. It really requires a thoughtful process that's specific to your situation with people who have a detailed understanding of your organization and people who have a detailed understanding of all these programs. We have a couple of seconds left on the survey if you're trying to get your CPE in. 5 more seconds. I know there's a lot of questions in the chat. We will get written answers out to everybody who's registered for the class. All right, so the most common answer is I have no feeling, or I'm sorry, it's I think attention to this would benefit my organization, number A. And then the next one is I have no feelings about this, I just want it to be over. So that's the majority. If you feel like attention to this is something that would be beneficial, but you don't have the time for it, it is worthwhile to bring in outside help, whether that's from Bonadio or somebody else. Don't simply just say, I'm not going to get to it, because there is too much opportunity here. So again, thank you for your time. That's the end of our hour. I really appreciate it. Thank you for the chat and your attention, and I look forward to talking to you again soon.